Good morning, everybody, or evening, wherever you are. Welcome into another pre-market live stream here with the Everyday Growth Advisors. Hope you had a great weekend. We put out a video over the weekend of all the trade breakdowns from last week. If you haven't watched that video yet, go check it out. Also, if you can, while you're at it, show me some love by smashing the like button both on this stream and also on that video. It really helps me out a lot, guys. You have no idea. And it's really important to help me to click the like button, because the YouTube algorithm will not share the video with other people until and unless more people like these videos. So I would truly appreciate it if you guys do smash the like button whenever you can. You know, it'll help us to spread this stream larger and wider. We want to help as many people as possible through the pre-market and through market hours. So yeah, I truly appreciate you guys, you know, being here, showing up, and also just taking your time out of your day. Last week was obviously a big whipsaw in the markets. I summarized everything on the newsletter. What is the future expectations, and also what were the reasons of this unwinding. Of course, we didn't expect to get here this quickly, but then again, you know that emotions and the groupthink mentality of the market prices in these situations much quicker than expected, and we are here. So what comes next? What are we going to be looking at today, all the way into Wednesday? And remember, if you are new to this channel, or you're new to this stream, or you're new to EGA, you should be following along with the newsletters every Sunday, which gives you a more macro view, followed by every Monday, Wednesday, and Friday we have a pre-market live stream that will kind of guide you through the week. And then every individual day, if you're part of our Discord community, you will get live trading sessions where you trade along with me in real time. That's where all of the trades from the trade journal come from, and we trade together live every single day of the week. So that's how things go here. If you're new, welcome in. And if you're returning, thanks for coming back. This next couple of weeks are going to be heading into the end of 2022. Yep, just like that, we're done with 2022. And we'll be ending the year with the S&P 500 down versus up from the previous year. We've had 2 consecutive strong years of ups, right? All the way from 2020 all the way to 2022. So this is a very natural pullback in 2022 to 2023, right? For us to consolidate to the mean and then expand again. Now, do we, you know, are we going to go all the way back down in terms of below or to the COVID highs? That remains a situation to be unseen. But there is a very high possibility that we try to break the lows again of the S&P 500 within the next quarter, which is Q1 of 2023. And there are a handful of reasons for that, as I've outlined in our newsletter. The expectations for the performance of equities in Q1 are, you know, they're bleak because of all of the economic situation, the ongoing tightening in interest rates, which are about to take place, and now the Fed revealing that it might be even higher for longer. Which is not a surprise, but it's more about how are we going to get there that is the problem. How fast are we going to tighten, and how long are we going to stay tightened? That's the issue which the market is questioning right now, and that uncertainty is going to be met with a lot of pressure in terms of emotions, which will lead to fear, and that's why the market is selling off here. So that's your bigger time frame summary. And now if we look into the granular view, then you can see that we have just broken down out of this uptrend, right? We've just broken down. So for those of you that think that, oh man, I lost out on this downtrend, remember that everything needs a motion of breathing in and breathing out. The stock market is a breathing representation of supply and demand, right? impulsive wave has to be followed by a corrective wave. Impulsive wave has to be followed by a corrective wave. Impulsive wave, corrective wave. Impulsive wave, corrective wave. Impulsive wave. And now this corrective wave is become the impulsive wave. So when there is a trend change, we get the impulsive wave becoming the corrective wave. And therefore, this is the new impulsive wave to the downside. What comes next is a corrective wave to the upside. And we are looking for that pullback to back test these higher levels here to validate that these are now going to be supply driven points, or resistance as you guys like to call it in the layman trader terms, right? For us, or rather for me specifically, I don't look at it as a specific point where resistance comes in. Remember that this to me is just supply. And the way I look at it is eventually what's going to happen is we will possibly hang around here for a second, but then we will come back to back test these levels, because at some point of time supply will run out, right? Imagine if you just have sellers in this market and then people expect the prices to keep going further down and down and down in a straight line. That never happens, right? So you have to be realistic about your approach. So with that big supply coming in, some demand will come in to counterbalance, and bulls will step in to try to defend prices. Where will that happen? Well, it could be either where we are right now, which is the 3861, which I already plotted out last week, or it could be 3800, and in this box right here where it's 3660 to 3800. This is the next little zone here where we see a lot of demand coming in. So anywhere in this range here, it's a pretty wide range, but this seems like a decent spot for us to consolidate temporarily, and then possibly hit one more leg down before that pullback. So expect possibly a little bit of a bear flag here and then a little pullback as what I've drawn here. And that pullback could come down into 3806 to retest, test this lows here. And then maybe we get that liquidity from here, paint the top here, and then reject here for that next wave down. I think this is a much broader view. This is like more of like a 2 weeks, 3 weeks view. But that's what I'm thinking about right now, heading into this next couple of weeks. Remember that it's easier to tell when a reversal is going to happen when you snag a zone of liquidity. It's you'll see a big reversal. You'll see a lot of buyers stepping in at that point. That's when you know, okay, we've hit a spot here. We've hit a nerve where supply has now met some demand, and that's typically where buyers will start to get aggressive because prices have fallen too far, and we haven't quite hit that right here just yet. So there is a high chance that we go a little further down into this zone before we bounce, and I don't think that dealers have built enough negative gamma exposure yet for us to flip on that end yet, knowing that a lot more people have gone short in this past week. So trend followers, hedge funds, they've all actually hedge funds have gone long here, because that is what they do. They take the counter position, right? Now hedge funds are a very small pool of the market, so you don't really need to worry so much about them. The main thing you should be focusing on is the fact that we're probably going to take some time to digest this pullback, okay? And that bull flag should take about a day or two. I would say maybe today it could be a bull flag. We have a really choppy open. Another thing is traders are going to be very reluctant to trade this week, because it's heading into the new year already, especially next week, because remember Monday is a holiday. It's Christmas. Market will be observing Christmas, and Monday will be a stock market holiday. And then right after that, New Year's also will have a holiday the next Monday after that. So likely to be a very choppy / non-eventful price action for the next 1 to 2 weeks until January kicks in, and then people start taking positions again. So you'll have to find pockets of volatility within the market in the underlying assets of the market, not within the S&P 500, not within the overall indices. I don't think that we'll get huge volatility moves up and down very, very wildly, but we might get these 100-point swings, which are very normal in this market so far. So that's what I'm thinking. That's the bearish scenario. The bullish scenario, which is obviously the less likely scenario, but it's always important to plan ahead of the bullish scenario, is we need to break above this 3950 and then start forming a base above 4,000 for us to get bullish. So we are very, very far ways away from the bullish scenario. that will also be a reversal and will require some kind of a catalyst event. Good news, something about maybe supply chains winding down, maybe OPEC talking about, oil prices or increasing supply, or oil, or the war between Ukraine and Russia being over, like all those things, if they put it together, if everything happens all together at once, and then somehow the Fed says, "Oh, we're going to slow the pace of hiking now that we've achieved our objective," yes, then yes, this bullish possibility can happen. But as of right now, the first scenario of us going lower is a more likely scenario, mainly because we just broke this trend, and remember, the trend is your friend. Okay. On NASDAQ, you can see that we have a very clear rejection of this zone right here, the 12,100. We never quite got past it. We didn't even make it to the pivot for bulls on NASDAQ. We never even came up to form that head and shoulders pattern. We just kind of rejected here, and we are probably going to continue dropping here on NASDAQ. So we'll be watching NASDAQ for a potential pullback as well. But as I said and I mentioned, watch for that. I think there's a very high chance that we get that bear flag, and then maybe a retest of one of these levels down here, maybe 11,000 or so, right? Where there's a little bit of liquidity trapped here, maybe a bunch of sellers waiting to buy, and then that pullback. So there's likely to be a small mini leg down first, another mini leg down before that pullback. That's what I'm saying, because we haven't quite snagged a liquidity zone. And then you have IWM small mid caps as well. Needs to come down to at least a 23 or 38.2 Fibonacci extension here for us to get that pullback as well. And of course, this is also a decent zone here for IWM to bounce, but we'll see what the price action gives us. I would be very surprised if the market opens like today and then immediately just whoop goes back to 39.50. But that would be a great setup to trade into anyway. It would be a nice one to play like semiconductors, which are like Nvidia. It would be a nice one to play, Tesla for a bounce, Microsoft for a bounce, Apple for a bounce. All these in demand zones, basically, right? So yeah. Not to mention the VIX is still a little elevated here. At around 22.83. Not scary levels elevated, but it's still a bit elevated, okay? And it will continue to get elevated the more we sell off in panic. All right, if you have any questions, post them in the comments right now. If not, I'm going to go through the usuals, in terms of market action. So another one was dollar index. Dollar index really felt the 103.63 breakdown yet last week. And has honestly, it has continued to bounce at this level a couple of times now. We'll see if we can get that rally in the dollar, which is what we're looking for. A lot of this thesis would be helped by the bond market. So remember that it all starts here in the bond market, then it spills over to here in the currency market, and then the currency market and the rest of the markets spill over into equity markets. That's how the flow of capital and the understanding of the stock market should be for you. If you don't know how these things are interlinked, then you should probably read up about that and get a basic understanding, or wait till I hold one of the live classes and we explain everything in there, with a complete explanation. So in terms of bond market, so what happened to bond rates pre? So let's see. Did TLH really change that much? We're just down like maybe 1%. Okay, that's not too bad. 1%, it could be anything, honestly. We are expecting to have a little pullback on bonds anyway after this impulsive wave of buying. This was pricing in the expectation of the Fed, or rather financial conditions easing, sorry, not tightening, easing, right? That's the reason why people went ahead and bought a little bit of bonds, expecting the tightening to be possibly slowed down. And now I think bond investors are probably taking a step back and saying, okay, you know what, we need to maybe just hold off buying more until we know more. So there have been a first round of buying, and there's likely to be a little bit of a pullback here on bonds to see a little more demand come in. because a lot of demand was already bought into that little dovish expectation, which turned out to be a hawkish expectation. And so that money that's flowing to the bond market right now is just kind of taking a breather, which is more than expected, and actually gives us a nice chance to enter for Q1, which would be a very good opportunity in the markets itself. So for those of you that don't know, my thesis is actually that the bond market will likely perform much better than the equity market in the first half of 2023. And this is mainly because of the risk environment. And then at some point of time, what's going to happen is bond yields might be higher than the S&P 500 earnings yield. And that will cause a lot of people to start heading into overcrowding the bond trade, which has already seen some inflow. Remember, if the market, let's say S&P 500 pays a certain earnings yield, right? Earnings yield in percentage in terms of, let's say, dividends, or you put together their earnings yield of all the companies in there. It may, let's say, come down to, on average, it's about 3% or so, right? And then suddenly the bond market or 10-year pays you, or maybe a lower duration bond pays you higher than this. People are not going to hold the S&P 500. They're going to dump it and rather hold the 10-year, because the 10-year is a less risky asset, right? It's like saying, why would I want to hold this asset that's risky when I can hold a U.S. Treasury bond that has almost no risk, right? It's a risk-free asset, assumed to be, because it's backed by the U.S. government, right? And they would rather hold bonds than hold equity if equities underperform in terms of earnings yield. So that's what the equity market has been kind of pricing in the past couple of months. And I've been watching this very closely. I already took a starter position on this. You guys should know I already have outlined it in the newsletter, and I've outlined it on the Discord. So yeah, that's something that you should definitely be keeping your eyes on. Now, this spills over into the dollar index as well, right? If the bond markets start sniffing out that inflation is going to be higher for a longer period of time, or the Fed has to keep rates higher than a longer period of time, then that's also going to put pressure on the dollar, right? It's going to put pressure on the dollar to the upside, because remember that creates an environment where QT, or quantitative tightening, it gets prolonged for a longer period of time. And if QT is happening, or the bond buying program is happening by the Fed, then that's going to make the dollar more expensive. So I don't know if many of you know how the bond market works with the interaction of the Fed, but I'll try to give you a quick rundown right now so you can understand. So remember that the Fed has a set of tools that they can use to influence interest rates. But they don't influence interest rates directly. Okay, so there are banks, the big banks, right? Big consumer banks, or the bigger banks. They have a interbank lending rate. This is what the Fed controls. Okay, that interest rate that you guys see the Fed raising, that's what the Fed controls. This is the Fed right here, and this is your banks: Bank A, Bank B, Bank C, right? So that interbank lending rate, the rate at which these banks borrow from one another, that is what the federal funds rate controls. Okay, and when the Fed has, for example, it wants to perform QT, quantitative tightening, right? Then what it does is it will go ahead and it will start its bond buying program. Okay, so the Fed will, so all of these banks, they all hold bonds, right? Obviously, you gotta always know that these banks obviously park some of their money. It's a requirement for them to park money in treasuries. Okay, treasuries. So they hold their money in treasuries, and what they'll do is the Fed will buy the treasuries from them. So essentially, the banks have to hand over the treasuries, right? And that will cause the quantitative tightening that we require. Okay. Sorry, wait, hold on a second. We need to redraw this. I got the figure a bit wrong. Where is my eraser? Okay, I'm gonna have to redraw this. So Fed, Bank A, Bank B, Bank C, whatever you want to call it, right? This is QT on the Fed side, and if they want to take money into the system, they're gonna sell bonds to the banks. If they want to stimulate the economy, then they will buy bonds and they will push cash out, right? So that's how this system is controlled by the Fed. Oh, I just realized that this is a terrible drawing. There we go. And once they do this, that controls the interest rate, okay? Because that will inadvertently control the rate of supply of money, okay? So when bonds are bought and sold, that will in itself control the interest rate, and that will also affect the federal funds rate. So when you hear the Fed talking about, oh, we're gonna perform quantitative tightening, they're controlling money supply. All right, money supply is what will cause the interest rate to fall or rise, and then that translates into how prices of the bonds work, and that's how it translates into how the price of the US dollar works. And when the US dollar goes up or down, all bond prices go up and down, then that has a correlation to equities, okay? If the dollar is more expensive, obviously if you think about it, if the US dollar gets more expensive, then equities become more expensive to buy, right? So people will be dissuaded from buying equities. That causes asset prices to drop, okay? If the dollar is cheap and liquidity is abundant and everything is like it's cheaper to borrow money, then people will take on more risk and borrow US dollars to buy equities for a higher rate of return. That's what sometimes also drives equity prices higher and also inflation, okay? So these are all the things you have to obviously understand about markets. There's a complicated web. There's a lot of things going on in the background. Sorry about the drawing. That kind of I'll get a better diagram next time to explain this to you guys. But that's in a nutshell what you got to know. Obviously, it's way more complicated than that. I'm just trying to dumb it down and put it in layman's terms so that you guys can understand that. Okay, some things that I'm looking at. Semiconductors, very important, and I'll put this alert out there for you guys today so that you guys can action on it. I'm looking for a rejection after a breakthrough 211.50 or 211, let's just say 211 period, right? If semis can break below this and start coming up to retest, then reject here at 212 or so. I would want to take some downside exposure on semis in the short term. You guys have already heard that, or rather understand that I'm bullish on semis in the longer term because there's a boom cycle that's going to be coming. But this little kink in the data in terms of inflation and the Fed, it causes a bit of a short-term problem here. Remember, in the short term, the market's going to be a voting machine, but in the long term, these companies are all heavyweight companies that will be voted by the weight, not by their popularity. Another sector that I'm looking at is energy. And I'm looking to short energy only temporarily, okay? Not long term. Remember that energy is still in a super cycle. We're in a commodity super cycle, and so we are looking for that bounce in energy. That's the reason why I haven't taken a short position on it. You could either play the proxy XLE or XOP. But personally, for me, I don't like the risk to reward ratio to the downside on energy just yet. If we can get a little bit of a buy up on it, then maybe. But if I see a rejection here, I'll be very cautious to take the downside, because you have this dual zone right here, even on XLE. If you look from a technical perspective, this is where demand is likely to come in. Demand already came in here a couple of times now, and so I will very apprehensively take a starter position for a short energy play. Just based on what OPEC was saying and what Russia was saying about oil, and what oil supplies are in general, looking at what how the price of oil is going. Obviously, everything plays into it. So there's looking at energy sector is a more complicated web that you have to actually look at versus just the chart, because the chart's really not going to tell you anything. Remember that technicals are only going to help you to a certain degree in trading. You have to understand the market deeply. It's an interconnected web. Tesla is the other one that I'm watching here. And Tesla with a nice gap, $4. We should see a little bit of a pullback on Tesla. I don't know if we will get ultimate pullback to 161 to retest this, backtest this. But that would be nice if we can get that. If we can even get up to 168 would be beautiful. That's also another possibility here. And yeah, that's all I have for you guys today. These 3 opportunities for this secular week. The rest of them are more granular views, things that I'm watching in the short, medium term. But if you have any questions, post them right now. If not, I'm gonna hang this stream out, and I will put the. I'll go trade with the team right now live on Discord, and yeah. By the way, I hope you guys liked the recap video. I hope that it was useful to some degree. I'll be doing that every Sunday now to kind of break down all the trades that we take. Some weeks obviously will be, a great week. Some weeks not so much. But either way, you'll be learning with me as I navigate my own trading journey. It's not always going to be easy. Also, for those of you that have messaged me asking me about the trading journal, let me clean up the Excel sheet and add in a few more things. Like on the small account sheet, I have added a stop loss calculator for you guys. You can do it either by calculating arbitrary stop loss, or it will even calculate the stop loss for you based on risk that you assign for it. So like assess acceptable risk based on your account size. So let me do a little bit of fine tuning with the Excel sheet, and then I'll put it out for download on our website, so that it'll be easier for everybody to access. All right. So more on the Excel sheet later. I want to make the main account part of the Excel sheet also better. So yeah, there will be some more additions to the Excel sheet before I release it. All right, guys. Well, I don't see any questions here. Once again, appreciate you guys taking the time out to be here. Hit that subscribe button, like button if you can. I appreciate you guys very much. Have a good trading day. And we'll see you back on Wednesday. This is just a short session to kind of brief you guys. Remember, don't get ahead of yourself. Don't take the reminder. Don't take the bearish position until you see the bullish retracement, and don't take the bullish position until you see the bearish liquidity grab. Okay, that's just my two cents for you heading into this trading session and into Tuesday and Wednesday. Well, Wednesday we'll be having the pre-market again. So keep that in the back of your head. Wait for that move to happen, and then take the position accordingly. All right. Okay. Peace out, and have a good one. Take care, guys. Love y'all. Bye.